Hi, everybody. We'll give just a couple more seconds to those that are still logging in, and we'll get started briefly. Okay, we'll get started now. Thank you everyone for your patience. My name is Jesus. I'm the program manager for Monterey County Business Council, and I manage the Building Business Back program. Before we get started today, I want to welcome our interpreter, José Luis. Para cambiar en español, por favor, oprime el icono del mundo en la parte inferior de la pantalla. José Luis, if you could unmute yourself and introduce yourself over on that end. Um, Perfect. For today's topic, for today's workshop will be business basics, cash flow management. And we have invited Sharon Mikesell from CalCoastal as our speaker. Sharon has been with CalCoastal for just over 2 years now, assisting businesses in Monterey and San Benito counties that were impacted by COVID-19, as well as assisting those who are trying to start their journey into creating their own business. So without further ado, I'll let Sharon take it away.
Thank you so much, Jesus. I'm going to share my screen here and we will get started. Okay, this morning we'll be talking about managing cash flow. It's presented by the CalCoastal Small Business Development Center, SBDC, on behalf of Building Business Back. We'd like to thank our sponsors. We are powered by the Small Business Administration and the California Governor's Office of Business and Economic Development. All opinions, conclusions, and recommendations expressed are those of the author of the presentation and do not necessarily reflect the view of the Governor's Office of Small Business and Economic Development or the SBA. A little bit about CalCoastal SBDC. We're in part of a national program that has over 1,000 locations nationwide. Small business development centers help stimulate economic growth through business development. We are a proud resource partner of the U.S. Small Business Administration, and CalCoastal SBDC serves Monterey and San Benito counties. That's 2 of the 14 counties that are served in the Central California Regional Network. What we do in particular is that we provide professional, no cost and no obligation business consulting, training, and resources to small businesses. Those services include sourcing out funding, helping plan businesses, and social media marketing and more. You can contact us for a no obligation consultation and feel free to go to our website at calcoastalsbdc.com. The agenda for today's session: what is your capacity? You should determine what you can realistically handle as far as cash flow. But what if you need more cash? We'll tell you a little bit about what lenders look for if you need to contact them about accessing more cash and how to proceed. Don't panic, there's resources available to you. So welcome to Managing Cash Flow. Taking this class today is an important step to building a better financial future for you and your family. As a small business owner, it's important to know how much cash is moving in and out of your business. You need to think ahead in order to meet your financial obligations, as well as run a profitable business on a long-term basis. What we'll talk about today in this class is introducing some basic cash flow concepts that'll help you get started. Let's talk about cash flow. Capacity is a measure of whether a business can afford a loan. That is, will there be adequate cash flow to pay the business expenses, including the new loan payment, on time and in full? So capacity equals whether your business makes enough money to pay all the bills. And as we see in the slide here, that amount of money that you make or expect to make is considered cash flow. And you want to make sure it's sufficient to pay all your expenses and have a little extra on hand because things come up that are unexpected. Existing businesses are measured by how they've performed in the past. And unless that loan will significantly change the business operations, the lender will rely in whole or in part on the projections for your income. Now, circumstances could allow a lender to rely more heavily on projections. And those circumstances would be expanding your existing facilities. If you are going to use money to hire more staff with the expectation that there'll be more sales, or if you're going to start a new business line altogether. For example, if you're adding a new product to those that are already being manufactured. But in general, an historic cash flow is how much money you've made in the past is shown in your financial statements, your tax returns, and usually they'll look at the last 2 years plus whatever you've done so far in the current year. But what if you're just starting out? Well, newly started businesses are measured by how they're expected to perform in the future. And that would be a projection. How much money you make already, the revenues, and how much money you will need to spend, expenses. So it's important to prepare a break-even analysis. This analysis will calculate the minimum amount of sales needed to cover your cost. This is especially critical for startup businesses because it'll show the sales threshold that you will need to surpass before your business becomes profitable. So the quantity of products that you will have to sell per month is called the break-even quantity, and they may call it a BEQ or the break-even point. So to determine that break-even point, you'll need information. Fixed costs, like your monthly rent, how much you pay in salaries, and insurance premiums that are paid at regular intervals. If you pay certain costs only once a year, determine what that monthly portion is so that you can come up with a monthly cost. But make sure you calculate that cost as part of the analysis. And variable costs could include the cost for producing your goods or delivering your services, how much it costs to maintain your inventory and buying additional equipment. Those variable costs will change with the sales volume, and the price is the amount of money that your customers pay for whatever it is that you provide, the product or service. So take some time right now and think about your personal experiences with cash flow management. No matter where you are in that cash flow continuum, you probably have some questions because situations obviously change all the time. Are you a beginner? Are you just starting out? Well, then you're probably needing to know a lot about cash flow. But if you're intermediate, you know something and you still have questions. But even if you're an expert, you probably still have questions too. Is this thing about business is it's always changing. So there's always many ways to look at things. So today we'll take 3 different views about cash flow. There's a cash conversion cycle, a cash flow diagram, and a business cash flow statement. And if you combine all these things together, These three views will provide a comprehensive overview of a cash flow system. So here we have a little diagram of the cash conversion cycle. There's three basic components. What starts out is, your business is going to pay for the raw materials. You got to start somewhere. You're going to buy the material to make your product. Then you're spending some money because your business is going to make the product or do the service using those materials that you bought. Then we move over to where you actually sell the product or provide that service. Then you get the money for that and you buy more materials and the cycle continues. Sounds pretty simple, but the trick to this is to know how long it takes to get through the cycle. The rate of conversion is what impacts the cash flow. So if you have a really short cycle and you sell the inventory and turn it back into cash really quickly, you've put money back into your cash flow system. However, if you have a product or a service that takes you a long time to get paid or a long time to produce your product, you will not be able to use the money that you paid for the raw materials while that inventory is sitting on your shelf or you're waiting to get paid. So this is where your cash flow conversion cycle really comes into play to keep things moving along. Now we have a really interesting diagram with a lot of things going on. And this is for people who like to picture things. So here's a big picture of a cash flow diagram. There's a lot going on here. So we're going to take our time and kind of go through it a little bit at a time. Let's look at the elements that make up this diagram. And I will put a little disclaimer out here. This cash flow system was designed by George M. Dawson, illustrated by Buck Dawson back in 1995. So we got to give credit where this credit is due to making this diagram. It's a representation of how cash flows in and out of the system. And there's many decision points and valves that you control in this. So when you start a business, money flows into the business via debt or equity. Let's say you put $30,000 of your own money into the business. Well, that equity bucket in the diagram has that. And in addition, you borrow $20,000, and that's the debt bucket. So that combined $50,000 is your available working cash capital. So the valves in this diagram represent decision points. Your decisions will impact the cash flow and increase or decrease your probability of success and how well this cash flow is going too. Some valves are going to be open all the time. So some of this cash is going to be leaking out of here. Those are taxes and debt. You have to pay your taxes and pay your debts. They're a constant drain on your cash, and that's why they're at the bottom. Some valves are partially open, like the sales, the general, and the administrative valves. What you spend on these are up to you. But as you spend that available cash, the balance in that center tank is dropping down. Now let's take a look at that blue box on the side there, inventory. You spend money on raw materials and some labor, other direct costs that produce your products that you're going to sell. Now let's assume that you're making a product, but those same principles will apply to services as well. But if you spend a lot of money on inventory, your money's tied up until you sell that inventory and you get paid for it. So then once again, you've got cash, but until that time, you don't have cash. It's still sitting in there. Fixed assets, they're usually pretty expensive. They're over down at the bottom in that gray box. Buildings, if you want to upgrade your space. Vehicles, equipment, computers, new technology. If you're purchasing something that's really expensive, it's going to tie up some cash. So a better option for you, especially if your cash flow is tight, might be to lease it. It just keeps the cash flowing a little better rather than a big purchase. A profit generator. That's that sales pump way up at the top at the left-hand corner. We have a sales pump. Now you want to make sure that pump is primed because you need to keep pumping sales back into the system because that's what keeps everything moving through the process. Speaking about moving things through the process, there's accounts receivable. Now, you might make a sale, but you're not going to receive that cash until you collect on it. So ultimately, you want to collect your accounts receivable into cash as quickly as possible so it flows back into that center tank and becomes available for you to use again. Some of these accounts receivable will not be paid. You need to realize this up front because that would be bad debt. If you've got somebody who owes you money after 90 days, you can kind of bet that that accounts receivable might not get paid. So if you extend credit and create accounts receivable, it's really important to follow up and make sure that you actually receive the payment. Accounts payable, AP, it's in the center tank. Those accounts payable are actually little bricks in that tank because that's money that you owe to vendors and suppliers who extend credit to you. For example, if you receive a product and service, but you haven't paid for it yet, you can still use that money. Bricks just elevate the water, but instead of having to pay for a product or service, you can use that money for marketing or paying another bill, but you still have to pay it eventually. So it's challenging to balance accounts payable and accounts receivable. You want customers to pay you as quickly as possible because you can get the cash in. But you also want to pay your vendors as slowly as possible because that's cash out. And so you can understand both sides of this situation. Ultimately, you want to have generating some excess cash flow for profitable operations. And that's that ECFPO. That would be excess cash flow from profitable operations. That's an unusual acronym, but that shower head there on the very right-hand side represent your paychecks. So you do want that. Now there's a broken pipe in there, and that shows how depreciation can be used to reduce your taxable income. We won't get into this for this class, for it's time management issues, but for a real broken pipe, you want to call a professional. And that's probably what you need to do for this situation as well. This is a good question to share with your accountant. So this diagram in general represents a cash flow system. And these are decision points that you can control. But of course, in business, you're not going to use a diagram. You're not going to sit there and draw a picture of what your business is doing and put little labels on everything you do. You're going to be using a statement, and that's going to tell a story with some numbers. The cash flow statement. This is for people who like to crunch numbers. The cash flow statement is a valuable decision-making tool. It's valuable for business owners, investors, and creditors. It allows everyone to make smart and informed decisions about your business. That first column in your cash flow statement lists money in categories such as loan receipts, owner's capital, and things like that. It also shows money out, such as operating expenses for accounting, accounts payable, advertising, and other things like that. There's an optional second column you can put in there that represents your opening balance sheet, startup costs. You're not going to typically see that in a cash flow statement, but I'm mentioning this to demonstrate how elements of an opening balance sheet transfer over to a cash flow statement. Now, the other columns that you put in your cash flow statement can represent monthly income and expenses. And based on what your business knows, you can generally project out your income and expenses for a year. But here's a note about sales tax. A good tip is to put this sales tax money in a separate bank account. And you don't want to commingle the tax money into your regular bank account, because when you make sales, you're collecting tax on behalf of the government. So it's not really your money to use. And most likely you'll be required to pay this quarterly and possibly even monthly to the government. So if you're going to be paying this back to the government, you need to determine the local, state, and applicable federal taxes and keep that money separate so that it's available to make those payments on time. Some cash outflows are fixed month to month, like if you have a lease payment, or if you're paying the cable bill or the phone bill, those are pretty much stable month to month, so you can project those. But some cash outflows are variable, such as advertising and utilities. So those variable amounts will fluctuate from month to month. You do have some control over how cash flows in and out of your business. You can decide what you will sell and who you'll sell it to and where and what price. And the same goes for some of your expenses. You can decide what space you want to lease or how much debt you want to carry, when you want to place advertising, how much raw materials you want to purchase, how many people are on your staff. Those are things that you can decide, and you can make an adjustment as you're going. These cash flow statements tell a story. They tell you how much money you have to run your business. And it tells you how much money is moving in and out of your business, where that money's coming from, where that money's going, and when that money is moving in and out of your business. And even though your specialty is probably making a widget or doing a service, you need to be aware of what your cash flow statement says, because that's what's going to keep you in operation. So these are categories taken from a sample cash flow statement from the Small Business Administration website. As you can see, there's not a lot of ways that you get receipts, but there's a lot of expenses that can be paid out. So be aware of this and have a plan to have receipts to cover it all. And I'll go over this for a little bit, just so that you're aware of what these categories can be. Obviously, you're starting with the cash on hand. So what you want is cash receipts. And at the top there is cash sales. That's the perfect thing that you want. You want cash sales because that's money, and it's what you want to have so that you can do all these other things. But other things that can be receipts are collections from credit accounts, cash from loans, or other outside sources. So you add up those total cash receipts, and it will tell you the total cash available to do all these other things that are going to be on the other column of the cash paid out. And in this column of cash paid out includes things that you purchase for your business. There's a lot of miscellaneous expenses that could happen. Other things are gross wages for your employees. If you need to get any sort of outside services, supplies, there's supplies that you will need to just keep your business operating. Repairs and maintenance. You want to make sure that any machinery that you need to keep your business operating is in top working order. So you want to keep them repaired and maintained. Advertising. You need to make sure that you have some sort of advertising, paid or word of mouth, something, because if people don't know about you, you probably won't do a lot of business. So you need to do some sort of advertising or have a plan and be able to pay for it. You might need a car. for delivery, for travel, just in general. Accounting services, you need to have someone to actually prepare your statement, probably. Legal services, you may need that. Rent, you're paying rent on your business, on wherever you are, you're paying some sort of rent or mortgage payment, something, there's a payment there. Telephone, utilities, insurance. Some businesses require a certain level of insurance to operate. Taxes, that includes your real estate taxes and other taxes. Income taxes you need to pay. Interest payments. There's other expenses. So if you total that up, you might have a loan principal payment or a capital purchase. Various startup costs. We might have a reserve, an escrow, other types of withdrawals. Put those all together, you may have a lot of total cash paid out. You might not have a lot of cash paid out, but you do need to keep track of it and what that cash flow is. Make sure you have receipts to cover it. So some business owners, they overestimate the revenue and they underestimate costs. That means at some point, they might have a cash flow crunch. They might not have cash available to meet those obligations. So consider developing a couple of different cash flow statements. Now, the best case scenario, this is your ideal situation. All your dreams are coming true. Then there's that worst case scenario. This is a much more conservative scenario where you have a bad month. You don't get the sales revenue you'd hope for. Your costs might be higher. But in the real world, the likely case is somewhere in between. It's like the Goldilocks story. It's not too hot, not too cold, just right. It's the most likely scenario, somewhere between that best case and worst case, because you really can't have a negative cash situation. Negative cash could mean game over. You won't be smiling. So what can you do? There are things you can do. You can increase your revenue. You can provide incentives for customers to pay in cash. You could start catering or doing something. Do have a brilliant idea for something you can do. You can sell gift cards. You can increase your number of corporate accounts. You can negotiate with vendors and suppliers. You know, they might give you a better term or a payment plan if you ask them. So don't be shy. Ask for better terms. Ask for a payment plan. Ask your landlord if you can pay your entire year's rent in 10 months instead of 12. You can reduce your costs during slow months. Adjust your staffing. Adjust your store hours. You could change your menu options. Adjust your pricing. There are things you can do to adjust to your situation. And of course, there's the things that you shouldn't do. Don't use your sales tax as financing. Some business owners feel they can use their sales tax in a cash crunch, and they hope that they'll be able to replace that tax when things start looking up. Well, this is kind of a risky bet. The penalties are pretty high if you don't pay those taxes on time. So if you anticipate that you might miss or be late on a loan payment or a tax payment, talk to your loan officer or talk to someone in there as soon as you know. If it's a loan officer, talk to them. They understand cash flow. They understand business challenges. And it's in their best interest to help you. They don't want you to fail. Loan officers do not want you to fail. They make money when you're successful because they want you to pay back that principal and the loan interest. Don't pay your vendors late. Why? Because they can cut you off. If you don't get your items from your vendors, you can't make your product. So this is a problem. So don't overestimate your revenue. It's a common mistake. Many new business owners tend to make it. And don't underestimate your costs. Again, this is a common mistake, but do your homework to find out the real costs of doing business, because sometimes prices do fluctuate, as many people are noticing now with the fluctuation in gas prices and supply chain issues where sometimes things don't come in on time. So just bear that in mind when you move forward and you make your planning so that you aren't stuck. So moving forward, how do you proceed? First of all, it's not a sign of weakness if financial management is new to you. So find a great accountant or a technical advisor, or contact us over at CalCoastal SBDC. We can explain cash flow in ways that can relate the concepts of cash flow to your particular situation. An accountant will encourage you to use a computer to manage your cash flow documentation. If you don't already use financial management software, we really recommend that you take a course to develop this skill. There's many courses out there available. You need to manage your paperwork in a professional manner. Putting things in a shoebox is probably not the best way to do things. Set up a reliable filing system to keep track of all your financial documents, such as tax forms, receipts, invoices. Co-opetition is a real term. Competitors can be great advisors for you. They're coping with the same cash flow issues you do. So find ways to cooperate and share information with them. They have experience to share with you. And identify ways to manage that cash flow. Make sure that you manage your costs, projected income. Keep good financial records should you choose to apply for loans or grants. And identify ways to seek out technical assistance to improve cash flow management. I really can't stress this enough. If it's not CalCoastal SBDC, do find a professional to talk to for an accountant or a lawyer, or there's a lot of resources out there. So key points to remember. Managing cash flow is a core competency of small business ownership. That balance sheet tells a compelling story. A cash flow statement continues that story. So make sure you use it to monitor your projected and actual income and expenses. Realize that fluctuations are going to happen. We don't have a magic wand here. We can't tell the future, but we know there will be fluctuations. Plan for those seasonal fluctuations. Every business has its ups and downs. Ask some of your competitors when their usual slow times tend to occur. You can plan for that. Try to maintain a rapid cash conversion cycle and not tie up too much of your cash in inventory. See if you can order your items to make your products, and it's just in time for you to actually create the product. Instead of a lot of cash flow to purchase equipment, see if you can get a lease instead of buying it. If you do buy equipment, check to see if you can get that equipment used. And buy used whenever you can, especially if you're just starting out, so that you can keep your cash flow going. Manage your paperwork like a pro. Your accountant will expect to see spreadsheets, an accounting program, well-organized receipts, invoices, and financial statements. Be sure to hang on to your banking and credit card statements. The more organized you are, the easier it is to deal with any sort of a loan application or dealing with a crisis that might come up. And once again, ask for advice. Ask an accountant or a no-fee consultant like those at CalCoastal SBDC. Hopefully, this class today has helped you prepare for a series of helpful conversations. Remember that us at CalCoastal SBDC, we are confidential, no cost, no obligation to you, because remember we were funded by the SBA and the Governor's Office of Small Business. We are also have local sponsors. It's no obligation and no cost to you. So those are great things for you to utilize so that you can get one-on-one consulting. And with that, I'm going to wrap up this presentation and throw it back over for questions.
Perfect. Thank you so much.
Stop sharing.
Thank you. Thank you. That was a lot of great information, Sharon. I want to remind everyone that the workshop is recorded and will be available on the website if you'd like to go back and view something you missed. And with that, we'll jump into questions like Sharon mentioned. If you have any questions, feel free to chime them in the chat box. We also have some people here that did have some questions. So in the meantime, while people write their questions, I'll start with the ones here physically. One of the questions was, if you have a cash flow crunch, can you recommend what expenses are generally okay to pay later rather than sooner?
Well, it's obviously going to depend on your specific situation. We don't recommend that you delay your tax payments or any loans, but you can try to negotiate if you think that you may have a problem paying your loan. Reach out to your loan officer and see if you can get that adjusted. The best thing that for general information is if you see a cash crunch coming, reach out to whoever you think you might have trouble paying and ask for longer terms. And to reach out to anyone who owes you money to see if you can collect on that.
Perfect. All right then. I have another question. They're asking if they would find out the break-even point is during the business plan step of beginning their business, or when would they find out what the break-even point is?
I think when you're actually working one-on-one with a professional, when you start actually crunching the numbers, you'll see what that is. It's kind of it's hard to explain in a general situation like this, but once you start crunching the numbers, you'll see where things start to even out.
Awesome. All right then. And then I have another question that says, is there a rule of thumb for how much to have in savings?
I think once again, it's going to depend on your situation. I know that when I talk to clients about government contracting, and I'll just kind of throw that out there as an example. If you're going to enter into a government contract, expect that you're not going to get paid for your goods or service for 4 months. So you're floating whatever money you sunk into that project for 4 months before you're starting to get paid for it. So if you feel comfortable with whatever it is to not get paid for 4 months, then you can move forward. And in every situation, like I said, it's going to be different, but just realize that you're not going to get paid instantly for your product or service, especially with larger contracts.
Okay. And then I do have another question. So based on how pricings are changing throughout any business, the price of raw materials is also going up. Should you plan for the change of pricings to go up or go down, or should you to prepare your reserve, or should you just wait to see the change and then tackle it at that point?
I think the answer to that is going to depend greatly on what it is that you're waiting for. And that's really a one-on-one question with a specific business advisor for that situation. There's so many variables for every different business that it's really hard to give a blanket statement on that one. It's a great question, but it's a very individual answer.
Perfect. Thank you so much. Well, thank you, Sharon, for being here. On behalf of Building Business Back program, I want to give thanks to you and to CalCoastal. I want to thank our host for the physical space today, which is in Prunedale Branch Library. And finally, I want to give thanks to County of Monterey for funding this program. It's free to you because Monterey has dedicated some funding to bring business back from the pandemic. If you're interested in learning more, like I said, feel free to visit our website at montereycountybusiness.com, where you'll find workshops, recordings of previous workshops we've also had. On the last comments, we will also be hosting our next workshop on navigating the permit center, which will be held on November 22nd. You can register for that on our website. And with that, that's the end of our workshop. Thank you so much for joining us, and I hope you guys have a great day.
Thank you.
Thanks, Sharon. Have a good day.